Thank you. Thank you so much. First of all, I'd like to say, it was a pleasure meeting Amber again. She said, I got you. I have you. I'm good at that. I'm good at that.
I refuse to give up the impractical shoes despite the limitations.
All right, thank you. Good morning, everyone. My name is L.G. Brooks. I'd like to say I am an NTPI fellow. I taught for NTPI. It's wonderful. Matter of fact, it's special for me to be here in New York. Cheryl Tribato, all right? We graduated together. This is our 25-year anniversary of being an NTPI fellow. How about that? We graduated in 2000. And so I want to say thank you all for inviting me to speak at your conference. This is a wonderful event. I don't take it for granted. Now, you may not agree with everything that I say. That's okay, but I'd like to have all the information that we present at Foundation based upon the code, based upon the statute, based upon cases. It's not about me. So don't think about me. Look, review the material. Because when you go before the IRS, you can't say, I heard LG say, they don't care. Matter of fact, they don't like me anyway. So don't tell them my name. But I see a lot of people here. I see Miss Shannon in the back. Hello, gorgeous. Good morning. So thank you all for inviting me. Let's get into this. Now, you have any? I like to save time for questions. By the way, no question is a stupid question as far as I'm concerned. Okay? If there's something you want to know, it may be some things you don't agree with. That's okay. You know why? Because at the end of the day, we need to know the truth. Okay? So it's okay if you say, well, LJ, I don't agree with that. Or an agent did this. Sometimes agents do things that they have discretion. That doesn't mean that it's correct or it's foundational. So we want to abide by the code, the guidelines, the Internal Revenue Manual. Now, the manual is the policy. It's not law. Internal Revenue Manual is the policy that all IRS agents ought to subscribe by. That's where the standard abuse of discretion comes from in general. If they don't follow their own rules, they're abusing their discretion. And so that's one thing we need to learn more about. But let's get into taxes. Now, what I have here, I want to get to the meat and potatoes of the presentation. I don't want to school you with the due dates. I put this in here because it's what employment taxes, right? We want to make sure because we may have some newbies or whatever. But that's not the foundation of why we're here. Most of why we're here is a lot of you know how to prepare 941s and 940s and all of that good stuff, right? But the core foundation of why I believe we're here is representation. That's what enrolled agents are licensed to do. We're technically not licensed to prepare returns, even though we can. We should know about that. I was speaking about Miss Vicky. I have two Vickies back there, but I'm talking about Vicky M, not Vicky H. All right? Vicky M, raise your hand. She's from Long Island. Okay, all right, New York. We were speaking about preparation, okay? Tax preparation. Some of you are not as old as we are, Miss Vicky and I. We were speaking about, we had to prepare taxes by hand. Matter of fact, I don't even believe there were computers out back then, Vicky. There were no computers, okay. We had to prepare tax returns by hand. Everything, individuals, partnerships, corporations, trust, you name it. Everything was by hand. Then you had your Pub 17. There were no computers, and that's how you learn. That's how taxation becomes embedded in you, not just the process of preparing returns, but you learn the ins and outs of taxation. And I'm grateful to being an enrolled agent. That's what I want to be. I took the CPA exam. I did. I passed 2 parts and was going back to pass the other 2 parts. And something came over me. This is not what I want to do. I really love taxation. I don't want to. And someone told me about, well, what about being an EA? EA, you never heard of that. What is that, enrolled agent? Well, that's where you're licensed to become a tax representative before that. Oh, my gosh, my eyes blew up. That's what I wanted to be. And it was the best decision, professional decision. And for me, is being an enrolled agent. I represent clients before the Internal Revenue Service. We are defenders of the code, believe it or not. You ever heard attorneys, and even the U.S. tax court practitioners, we have some in here, Frank Deacon, Cheryl, and Amber, when they're in court, you are a ward of the court, whether they want to be or not. You're a ward of the court. As an enrolled agent, you're a ward of the code. You must follow that code, whether you agree with it or not. If you want to change it, then you take, that's a judicial process. But until then, we must follow the code and make arguments based upon the law. That's why it's good that we know the law. And the code is the law. What's the purpose of Treasury regulations? Treasury regulations explain the law. That's the purpose of Treasury regulations. Here's the code, the law. Regulations, this is how the law should operate. IRM, policies. This is how you all, as employees, are to implement, to follow the guidelines of the law, but it's policy for them. So they're not allowed to step outside of that policy. Otherwise, they're abusing their discretion, which we'll get into later. All right. I talked too much, so let me see. Oh, it works. Here you go. Employment tax matters. Now, if you don't mind, I learned early on when I first started speaking with Bob McKenzie and Cheryl and everyone that I understand I can't please everyone. I get that. My goal at the end of the day is to make sure I give you something that you can use, that you can take with you. Because when we leave here, we need to be prepared to actually represent, to use our EA credential to assist taxpayers to follow the law, to implement the law. That's what this is about. Now, as I said, I'll run down the dates and all of that in the 941. That's not the emphasis of this presentation. The emphasis of this presentation is representation. But I put that there since we just want to start off with the employment tax matters. We have to know what a 941 is, a 940, and all of that. But then we'll get into the meat and potatoes. Is that okay? Now, I know everybody won't like it, but that's okay. All right? Let's get through this. Let's get through this together. All right? If I can learn how to operate this. There you go. I don't think I passed anything. There you go. Oh, all right. So we want to start with just the basics. You know, you have these two basics, federal payroll taxes, employment and unemployment. And all of you are familiar with this. So there again, I don't want to bore you, but I have to lay the foundation. We're speaking about employment taxes. And this is where it starts, with the filing of all these type tax returns. All right? 940, unemployment, of course. And here are your rates if they haven't changed them recently, because sometimes they change things overnight. So when I wrote this, maybe they changed something, maybe they haven't, but they should not have. All right? And here are the basics for the federal unemployment. Now, I'm in Texas. We don't have state income taxes, all right? But we don't have any state income taxes, but you guys do. So you guys get a double whammy. So I'm not familiar with New York. Do you guys file New York 940s and the equivalent? Wow, that's amazing. Geez, so my gosh, so you guys, we don't have state taxes in Texas. It's like, yes, but in New York, you guys have the federal, and you have not only for income taxes, but also for payroll. Oh my gosh, that's terrible. Oh my. Why do you guys live here? I mean, okay. Frank told me this years ago when he came with NTPI. He told me Frank would come to NTPI and he has this big voice, you know, and he always get up in front of everybody, the Empire State of New York. Frank, get out of here, you know. But I love that guy. That's Frank's Deegan in the back. So, all right, now, federal withholding. A lot of people get caught and report it quarterly on the 941. And don't forget, we're getting to the meat and potatoes here. I'm just running down some things and some forms that you guys know or should know, all right? All right, reporting annually, you got the 944, Form 943 for agriculture, reports contributions on Social Security, Medicare. All of these are things we're accustomed to. You all know about the preparation of forms. She didn't bring me here for that. So, LG, you wasting my time. But I just want to lay the foundation of what we're speaking about, employment taxes, and it begins with the 941s and the 940s. A lot of people run into problems with what they're not filing the 941s, or if they're filing them, they're not paying them, things of that nature. That's what we want to deal with. How do I deal with representing taxpayers that have employment tax matters, employment tax problems? You're going to run into, if you already haven't, and I'm sure New York probably has some tough not rogue, I didn't mean to say that, I'm sorry. Revenue officers is what I meant to say. Revenue officers, all right? And by the way, So since you all have state also, so you all have the equivalent of revenue officers at the state level. My goodness, why do you guys live here? I keep asking that. you guys are gluttons for punishment, aren't you? I mean, but I deal with rogue revenue officers enough on the federal level. Revenue officers can be, I don't know, they're not training them as well today or whatever, but we're training them. And one of the worst things to deal with, in my opinion, not worse, I don't mean to say that, not just revenue officers, but when we deal with an ATRO. Anybody ever dealt with that? I know probably Cheryl has it, Frank. That's an abusive tax avoidance transaction. They're called ATROs. Now, you do have some ATRAs, revenue agents. But the most I've seen are the ATROs, revenue officers, and that's a step below criminal. Whenever you're assigned to an ATRO, step below criminal, abusive tax avoidance transaction, revenue officers. You don't run into them all the time. Just want to make sure because I hadn't for a while, but I did, and didn't know who I was dealing with. And I think they should inform me who I'm, just don't tell me you're a revenue officer. Please let me know you're an ATRO, because now I know you're seeking more than just to collect the tax. You're also seeking to find elements that my client committed fraud or some other type element of that if you're ATRO. So be on the lookout for that, and we're about to get into all that. So everybody good with 940s and 941s? Anybody don't know what a 941 is in here? Because I'm about to put you out of here, all right? Come on, you know what a 941 is. That's the federal tax return that's prepared quarterly when you have to report your employment taxes and things of that nature. You file that quarterly with the federal government. That's with all of the withholding. When the employer is required to withhold federal income taxes, Social Security, Medicare withholding, you have to report that on that 941 and send it to the government on a quarterly basis. And that if not, a portion of those taxes that they withhold, they're called trust funds. And the entity has to match not the withholding, but the Social Security and the Medicare. That's the matching portion, okay? That's not considered trust fund. Only the portion that is withheld. And the government is becoming very serious about that, not following guidelines regarding, pursuing a person regarding trust fund. That's one of the main issues why we're here today. What do I do within the context of representing taxpayers with respect to employment tax matters? As I said, most of you, if you haven't, you know what a 940 is, 941s, you do that. You crunch those figures out. After you crunch those out, now my client either didn't file it timely or didn't pay the tax. How do I properly, legally represent this taxpayer before the IRS? What should I do? How should I do it? When should I do it? And, Shannon, why should I do this? We have to make decisions as representatives. And it's not always easy. Here are the deadlines. We're going to get past this, but here are the deadlines of filing the returns, all right? There again, you all didn't come here to learn the basics again about filing returns, but I put it here just to lay the foundation for what we're about to enter into. And here's the determine the deposit schedule, regarding the deposit schedule determined by a look-back period, so on and so on. Under 50,000, over 50,000 does not affect the rules for the next day deposits. Most of you all still prepare. How many of you still prepare 941s and 940s? Not a lot? A few? Half the room? Okay. Right now, I'm in a position where I just represent clients. But there again, because I do represent, I don't prepare anymore, tax returns or anything of that nature, I still need to know the mechanics of how these forms work. I still need to understand the underlying concept of 941s, 940. How can I represent a taxpayer if I don't know the ins and outs of that form and why? Okay, so that's the foundation of this. Now, if you want to deposit taxes, if the business consistently owe under $2,500, this is allowed to be filed with the returns. Anything over $2,500 due by the 15th of the following month. And some you have that the taxes are due 3 days after they make the payroll. You have to know all the rules, right? She's shaking her head. She agreed. Okay, you got that one right, LG. Thank you, ma'am. All right, let's keep going. Now, This is a schedule, and we're going to get to the good stuff. I'm just laying the foundation so you didn't say, well, he should have known all. Well, I'm just giving it to you now. If over 50,000, here's the next day deposit rule. Any day where over 100,000 accumulated, deposit must be made the next business day. So on and so on. These are all, look at all these rules you have to know, and I'm sure probably New York State has some similar rules regarding depositing. So when they don't deposit, and a lot of people think that the late payment of taxes is the most expensive. It's not. It's the non-filing or the late filing. I think you all had a class yesterday on non-filers. You know, boy, are they running the gamut on non-filing when you don't file returns. You're just giving the government more time, okay, to come after you. You haven't even started the statute to run yet. When you don't file timely, the statute doesn't begin to run until you file the return. That's the ACED, the assessment statute, but then on the collection, statute doesn't begin to run until what? Until the taxes have been assessed. That's the CSED. So you have two different statutes there that you're mainly dealing with. We're not very concerned about the RSED, the refund statute expiration date, but the ACED and the CSED, those are the ones that are at the top of the game. ACED, CSED, assessment statute, and the collection statute. Those are the big ones, all right? And sometimes taxpayers do things that do what? Extend the statute of limitation without even knowing it. So when you're a non-filer, statute doesn't even begin to run. So when you take on a case, you're saying, oh, this is a 2009 tax year. And if you're not careful, you make the assumption, oh, the government should have abated this years ago. Stop. Stop. We need to do our homework before we make all these assumptions. I learned the hard way, never make assumptions in taxation. Here I am, an eager EA, scared, oh, this should have been abated. And then you obtain the transcript, and you analyze it, and you realize that the taxpayer, one, didn't file that 2009 return until 2016, okay? They filed late, first of all. So the statute didn't begin to run until that year. Things of that nature. So let's stop, take our time, take a step back, and we were just looking at what we had before us. No, before we make any allegations or movements, let's determine the proper foundation. Did you file late? Sometimes they extend the statute by signing a document. It's either 872, that's exams, where you extend the statute. Or it could have been a form what? 900, right? What's a form 900? You're absolutely right, sir. He said that's where you waive the statute. I don't know how to use the different terms. You extend the statute in exams, but you waive it in collections. It's a waiver. In exams, it's an extension, but the results is the same, okay? The statute is continued. So we're going to get into all that. Now, penalties for late FTDs. These are the penalties for late FTDs, 2% 1 to 5, 5% 6 to 15, 10% over 16 days. Okay, that's the late payment of the tax. Social Security, employee versus employer. We spoke about that earlier, where employees pay 100% of the federal withholding, employees pay 100% of the federal unemployment tax. Employers, all right? Now, employment tax matters. Disqualified employment tax levy. Red light. This is where we begin the process of representation, all right? Everybody familiar with a DETL, correct? She said, no. I see somebody in the back. She said, I don't know what that is, right? Is that what she said? I don't know what that is. Disqualified employment tax levy. That only pertains to employment tax matters. That's why that's here. It's not income taxes, employment taxes. Disqualified employment tax levy, okay? That's where the government, in certain instances, and we'll get into this, is allowed to levy your taxpayer first, provide them with their rights later. Disqualified employment tax levy. How many of us are amiss by not reviewing that taxpayer's history when we take on an employment tax case? For example, someone comes in with employment tax problems, all right? Hey, I want you to represent me. I have this 941 problem, and I want to file a CDP. I want to file a collection due process. You file the collection due process timely, and the government levies your taxpayer. And it was filed timely. What happened here? You can't do that, IRS. You're prohibited by federal law from levying my client. If the CDP is statutory, it's different from audits, and we'll speak about that tomorrow. Those are two different type of appeals. and one is statutory, the other one is not. It's allowed. But we'll get into all that. But the point is, disqualified employment tax levy where they're allowed to levy your client first. So it's your job. The reason I'm raising this is because you have a duty to determine if this taxpayer has previously filed a CDP within the previous 2 years. So before we jump into an employment tax matter and there's a levy, potential levy, or on the table, you need to investigate. That means access the transcripts. Obtain at the very least an account transcript to determine if this taxpayer, and the reason I'm telling you this is from experience again. Again, I assumed that, okay, I'll just file a CDP. That'll take care of all the problems. Not with regards to employment tax matters. And we want to bring this up because we want you to take that extra step to review, to ask, to ascertain, ask the client, have you ever filed a CDP regarding an employment tax matter within the past 2 years? What is your client going to say? I don't know. Or they're going to say, no, I haven't. Or I don't know. But most people will say, no, I have not. Still your job to review that transcript because 9 times out of 10, they have. And I got caught that way because I didn't do my homework. I didn't do my job properly. Why am I throwing myself under the bus? So you all won't throw yourselves under the bus. It only took one time for that to ever happen. But it never happened again, Shannon. One time. So from now on, every case I have regarding employment tax matters, I take a look-back period for the taxpayers that I'm representing the client, and I look back 2 years, and I determine if they've ever filed a CDP. If they have, they are subject to a DETL, disqualified employment tax levy. Just want to make sure you understand that process. We're going to speak about that a little bit more. Here it is. Code section 6330H. Okay? Defines a DETL as any levy in connection with the collection of employment taxes for any taxable period if the person subject to the levy or any this is important, predecessor thereof of that entity. Sometimes they sell entities. And the entity was subject to the CDP. Not just the current taxpayer, but if the predecessor requested a hearing under this section with respect to unpaid employment taxes arising in the most recent 2-year period before the beginning of the taxable period for which the levy is served. In other words, look back 2 years. Look back 2 years that they filed a CDP. Well, we bought the company, so we didn't file one. What about your predecessor? Same entity. What about the predecessor? Well, we don't know that, LG, and that's where the transcripts will provide you with that information. Transcripts carry a wealth of information. Obtain an account transcript and review that. Now, there are different types of transcripts. We understand that. We even have what we call the tax mod A's, the MIFTR X's, which you're allowed to get. Those are internal transcripts. The tax mod A and the MIFTR X carry a lot more information. But this is the code section 6330H, which operates in the same manner as an FPLP. All right, everybody familiar with that, correct? I take that as a no. Federal Levy Payment Program, okay? That's where under that program, if the taxpayer is a federal contractor, the government is allowed to do what? Levy first. It's almost like a lien. They file a lien first, right? Then they notify you 5 days afterwards. Liens are allowed to be filed first. Then we'll notify you. In that manner, the taxpayer is not allowed to abscond with the assets. So file the lien first. Then under federal law, then you can inform them of the rights to a hearing. Levy, notify them 30 days prior to a levy. You're required by federal law. Unless it is a DETL or an FPLP. I'm not required to notify you before I levy you. I can levy you now. And then I'll provide you with your rights. So be aware of that with regards to these employment tax levies. I want you to remember, if you've never heard of a DETL, it does exist, it's there, and I've dealt with these before. Now, legal authorization. Although the previous RS code H defines DETL, 6330 provides the legal authorization for issuance of that DETL. We're giving you the code. We're giving you the law. So when you leave here, you want to read that code, those code sections. All right? The addition of 633F became effective pursuant to the Small Business Opportunity Act. All right? and we provide you with the chief counsel notice that they issued on this. It's very powerful when you take on, I'm dealing with one now in Texas, where, well, no, that's on the trust fund portion. But have you ever known, and probably some of you have cases where just the trust fund portion is $7 million. That's what I'm saying. I'm trying to, just the trust fund portion. You can imagine how much the tax debt was on this case. Fortunately, we were able to obtain a offer in compromise at the entity level. Beautiful, great. And then you inform the taxpayer, well, if you can't pay, then we'll attempt to represent you. But before you file an offer on an entity, a corporation or any other entity, the IRS, per the RM, they're required to address the trust fund portion before they resolve the entity. So if the entity has unpaid employment taxes, okay, but before we enter into any type of offer or anything, we need to address the trust fund first. We're not doing anything. Everything stops. Now, let's address the trust fund. It either needs to be assessed, paid, or considered. Read the three. Some people say it has to be assessed or paid. That's not true. Read the IRM. It has to be assessed, paid, or the RO has to make a consideration whether to assess or not, or what they need to do. One of those three things have to happen. And we're about to get into trust fund now. But I wanted to give you the definition of the DETL, how it operates. I want you to, when we leave here, be aware of it. Maybe we won't encounter it, but all it takes is one time for your client to be levied after you, Cindy, have filed a CDP. And Cindy's thinking that you're safe now, client. She tells her client, go home. Don't worry about anything. Your bank accounts are safe. And they are not in their levy. I just assisted a friend of mine. He's a CPA. He does not like representation whatsoever. He's a CPA. He was very smart. But he called me. I need your help, LG. My client has been levied. My client has been levied. And this client, he's a very known, he works with a very known gospel musician that's nationally known, this gospel musician. So they levied the taxpayer's account. He called me. I said, okay, what have you done? What have you not done? And so on and so on. And the thing about it is, it was right before the shutdown. Now, some of you may be dealing with, I don't know, I have more than one case, Shannon and Cheryl, whereas revenue officers did certain things immediately before the shutdown. Anybody else dealing with the same thing I am? They issue you too? They issue levies right prior to the shutdown, knowing that as of, let me see, this is what, November, October? What is this, October? Oh, I'm sorry, bro. I get the months mixed up. As of October, that's their last day in office, if the government didn't resolve the shutdown, right? Technically, it was the last day for the appeals and collections, and the last day was October the 7th. Well, they're issuing levies on October the 6th. Knowing that, they would not be in the office for you to call them to resolve the issue. So the levy, that 21-day period, more than likely will expire. And those forms will be, they levied this, every penny of this musician's account. It was like, yeah, it wasn't a lot of money, but to me it's a lot of money because I don't have that much right now. It was over $200,000. And he's trying to figure out, I said, the revenue officer's not there. No, tell you what I'll do. I'll call ACS and see if they have some countermeasures or some other procedures for emergency situations. They do not. If a revenue officer is control of the account, you call ACS. Now, ACS is still functional, by the way. ACS and Practitioner Portage Service, they're called essential services. So they're still available. You can still call and get transcripts and things like that. But the revenue officers, they knew what they were doing. And this is on more than one case that they issued these levies before they left, knowing. Now, I think that's essential that you should. Now, they did leave about, I think, 30 revenue officers operational. But that was only to handle the cases that had short CSEDs. That was it. Only for that purpose. Any other purpose? No, only for the short CSED cases that they want to make sure that they push those through. They did leave some revenue officers functional for that. But we're about to get into some heavy stuff. But I want you to be aware of the DETL, how it functions. I gave you the code section. Read the keep counsel notice. DETLs are active, all right? They're functional, and your client can be harmed even after you file a timely CDP. That timely CDP does what? Statutorily stops, legally stops the levy. With the DETL, the levy's already been issued, and your client is going to be wiped out. So don't tell your client you're safe if it's an employment tax matter. That's why we're here today. I want to know about some issues regarding employment tax matters, LG. Not just regular levies, employment tax matters, and that's why I want to bring this up here. Now, we're almost off of this, though, but it's generally authorized to issue it only after the taxpayer has what? Now, I want to give you the foundation for that because sometimes your client only requested an equivalent hearing. They did not request a true CDP, where they filed the CDP timely, all right? That's a true CDP. But if they missed it by 1 day after the 30-day period and they filed it on the 32nd day, that doesn't qualify as a CDP hearing. That's an equivalent hearing, all right? Whereas a CDP hearing, we know legally, you're prohibited from levying. Also, legally, what happens to the statute of limitations, the collection statute? It's told, it's stopped. When you file a timely CDP, it affects the CSED, stops the statute from running. However, if you file an equivalent hearing, how does that affect the statute? It keeps running. Oh, I'm going to put you up here to teach this. She said it keeps running. She's absolutely correct. And you need to know the difference because sometimes you may professionally make a decision to not file a CDP timely. Have you ever done that, Emily? No. She says she has not. But you may have to make that decision. Why, Emily? Why would Emily not file a CDP time when she knows when she does that, it will stop the levy?
Because they don't want to stop the CSED. They don't want to stop.
The CSED, right, because Emily did obtain a transcript, and she said, wait a minute, the CSED expires in 6 months. So why should I file a timely CDP? We need to stop and slow down because sometimes I've done that. Oh, I need to file a CDP. I'll get the government. I'll file that thing timely, and that'll make you back off. The government says, thank you very much. You gave me just more time to do what we need to do. Take a step back, and I'll review the transcript. Oh, it expires in 6 months. I'm not filing a CDP. And the client says, LG, it says, if you don't file this in 30 days, here's the client. You know, the clients want you to do what they want you to do. You don't file this time. Hey, look, dude, I know the law. I know what I'm doing. Why did you hire me? I don't need you to school me on taxation. I don't think I need you to do is pay me, all right? That's what I need you to do, all right? So you file it. I wait just 1 day later, file it untimely. It's now considered an equivalent hearing. Statute continues to run, right? We have 6 months left, right? Once you file that, it takes them 30 to 45 days before they even log it in. That's almost 2 months gone. Now they have to assign it to what? An appeals officer. That's 3 to 4 months down the road, correct? And by the time the appeals officer contacts you, okay, LG, I'm ready for the hearing. I said, thank you very much, but I don't need you anymore. Why? Now the tax has already been abated. Have you ever noticed, by the way, we're going to get back to this, when you read a transcript, when the statute is about to expire, and you know it's 10 years, when do they normally, and this, read the transcript, when do they abate the tax? After that full 10-year period? Read the transcripts. Almost always, on every case I have, they abate the tax 1 month before the statute expires. 1 month before the statute expires. So you get a free month. Check it out. When they abate these taxes when the CSED expires, it's 1 month before the expiration date. That allows them time to do all their mechanics and whatnot. All right? But we're dealing with a case. Where's Vicki? Vicki Herman. She works in the office with me. All right? So there's a case that we picked up in Buffalo. Well, it's a Texas case, but we work it out of the Buffalo office, whereas the revenue officer. Now this lady, she's kind of, look, but she filed we're about to get to this too. I know I'm jumping around. 1153. See, they're aware of the CSEDs and all that. Don't think they aren't. They're aware of that. Why would you file a letter 1153 a day before the ASED expires? Not the CSED, the ASED. The government has 3 years to do what? To assess Why would you file an 1153 one day before, and then we're going to get to the 1153. Keep that in mind. It's very important about what we're discussing. But here the CDP, don't forget, if it's an equivalent hearing, it doesn't fall under the DETL. I want you to know that. Why? Because I held a case to where they say, well, I'll file a DETL. I said, no, you won't. They don't qualify. Well, they filed a CDP. No, they did not. It was an equivalent hearing. So you have to know what your client did, what type case they requested, because they'll try to throw them under the 2-year period. They look back 2 years. Oh, your client requested a CDP within the previous 2 years. So we're not required to issue you a final notice of intent to levy on this new period. We'll just levy you now. DETL. No, you're not. What do you mean, LG? Who are you? You can't. No, it's not me. It's the law. You're prohibited by federal law from doing that. If it wasn't a CDP, if it was only an equivalent hearing, that doesn't qualify under this statute. Okay? That's good for you to know. DTL is authorized even if tax withdrawals from the CDP. Well, my client did file a timely CDP, but they withdrew it. And you're allowed to voluntarily withdraw your CDP. You can do that. Don't want it anymore? Okay, is that done now? Even though they withdrew it, does it qualify for the DETL purposes? Yes, it does. If they withdraw it, doesn't matter. You requested a CDP. So it qualifies even if you withdrew it. So you need to know all these elements regarding DETLs, and they may be on the rise. I'm dealing with some now, okay? Now, here's some exceptions. Basis for issuance of DETL exceptions. The IRS has determined that the collection of the taxes is a jeopardy. 6330F1. The IRS has served the levy on a state to collect a federal tax liability from a state tax refund. That's where it comes in more importance for you in New York. See, we don't have that in Texas, but for New York, there's that code section, 6330F2. The IRS has served the levy on a state to collect a federal tax liability from a state refund. Okay? They can proceed with DETLs under those. Other requirements, and we're going to get past this because we're going to have some other issues we need to deal with. Who's keeping time for me? Did Amber leave me? So Cheryl, are you keeping time for me? Thank you, sweetheart. I appreciate that. Other requirements of the DETL. Prior to the issuance of a DETL, the IRS is required to verify the provisions. See, they're required. We wrote a presentation not too long ago regarding the IRS's duty to investigate. Duty to investigate before you do something, or if they did something, alleged something. That's a very nice. But here, they're required, prior to the issuance of that, they're required to verify 6331D, notice of intent to levy have been followed. They must have previously issued a CP 504 or a letter 1058. Either one of those. CP 504 is the preliminary to the letter final notice of intent to levy. They must have issued this levy. This is, a lot of times the client received the CP 504, when you read it, it says final demand for payment, notice of intent to levy. But the first thing it says, final demand for payment. They skip over that. All they see is notice of intent to levy, I'm about to be levied. Stop, when your clients receive a CP 504, this is just my recommendation. I used to tell them, oh, calm down. Stop, don't worry. The IRS cannot levy you with this notice. They can only levy a state refund. New York, they can do it with a CP 504, they can levy a state refund. Texas, we don't have that. But my point is, I should tell them, oh, don't worry. I stopped telling clients that. Why? When you tell a taxpayer, oh, don't worry about that, it's all good, now what do? They disappear. Okay? You call them, they don't answer. Okay? You just calm them down, they're gone fishing, went on their vacation. I stopped telling them that. I said, oh, did you read the notice? Final demand for payment? Notice of intent? Yes, they do intend to levy you. Okay? So we need to begin working now. Start the process now. But definitely when they receive a letter of 1058, final notice of intent to levy, that is a legal notice, by the way. The IRS is required to send that before they levy. They have no way out of it, statutory. Okay, so final notice of intent to levy, that can be a letter of 1058, that can be an LT11. It's not always a letter 1058, it can be an LT11, it can be a CP90, it can be a CP297. All of those are notices of intent to levy. So you need to familiarize yourself with all of those. Okay, let's keep going. Unauthorized. The IRS is prohibited from issuing a DETL when the taxpayer has filed an untimely request. What do you mean by that? That's just a equivalent hearing, LG. No. No, these are things we need to know. Filed an untimely request for a CDP, that's subsequent to the 30-day period. Well, if I filed a subsequent to the 30-day period, that's automatically an equivalent hearing. Not so quick. That's not what the rules say. When the taxpayer is requesting an equivalent hearing, maybe. Please note that an untimely CDP request is not legally the same as a formal equivalent hearing. I want you to read IRM 8.22.5.2.4-4. It explains that in detail they're not the same. Okay? It's when you file it, you had intent for it to be treated as a CDP. Now on the boxes on the form 12153, everybody familiar with that? I take that as a no. Come on, you guys don't get out a lot, do you? The form 12153 is the form that you use when you're requesting either a CDP hearing or an equivalent hearing, correct? All right, you with me? He's with me. I have one friend in here. Okay, he's shaking his head. That's the form you file when you're requesting a CDP hearing or an equivalent hearing. Now they put on the box at the very top, if this is not to be treated, if this is not determined to be a CDP, check this box. You're requesting that we treat it as an equivalent hearing. Now they have it on the form. But technically, per the RM, untimely CDP request is not legally the same as an equivalent hearing. All right? Now, we're almost through this because we have some other important things we need to discuss. The IRS may serve or issue a DETL during the course of an actual CDP hearing. Wait a minute. I'm in the middle of a CDP hearing with an appeals officer. Why are you issuing a DETL? I'm already in appeals. So the IRS may issue a DETL during the course of what? Actual judicial review. Now, you would think that would be a total violation. Whereas, for example, the IRS is not allowed to issue a summons when the case is being referred to the Department of Justice. You're not allowed to. Not allowed to do that. However, the DETL crosses lines. They may issue it during a judicial review. You need to know that. Well, I'll just hire an attorney, and I'll do this. Okay, the IRS is still allowed to issue that DETL. Why we have this? We want to inform our clients. We want to know how it operates. Because this young lady may tell her client, no, the IRS can do this, but then I don't believe you. And they go down the street and get some other advice from another person, and now they're irreparably harmed because they didn't follow her advice. They may continue to serve subsequent levies on the different levy sources for the same period while the case is pending in CDP before appeals. They can continue levying your client. I want you to understand the harmful effect of a DETL, which only pertains to employment tax matters. Again, they're serious about that. However, the IRS is not prohibited from seizing and selling the taxpayer's assets while the CDP is pending. We can seize your assets. We can sell them. You see the dangerous element of a DETL? If you weren't aware of it before, read all the code sections I gave you. Now you are. So you can't leave the New York State Society saying, I didn't know. You understand? So now you do know about the DETLs. All right. Cheryl, how am I doing? I'm good, okay? Almost finished here. Notification of the issuance. DETLs are usually issued by a revenue officer and are required to be remitted to the taxpayer via a letter 1058D. You see that little letter D? I missed it one time. All I saw was 1058. Vicky, I had to back up. And I saw, what does that D mean? Then I had to research the RM. That meant that was a DETL. Okay, pursuant to a letter DETL, notice of levy. Notice of levy. You get it? Not notice of intent. You don't see the word intent there. Notice of levy, and your right to a hearing. Must be sent by certified mail to the last known address, LKA. That's another important element, last known address. If certain legal documents are not sent to the taxpayer's last known address, they are deemed invalid. That's even with respect to a notice of deficiency. So also with a CDP. Copies are required to be mailed to the taxpayer's POA. Now you may think, well, I didn't receive it, so it's invalid. Nope, that's just sent to you as a courtesy. They send it to the taxpayer by certified mail. They don't send it to you by certified mail. Now, ironically, the government continues to send notices of deficiencies not only to the taxpayer but also to you by certified mail. I don't know how they stopped doing CDPs like that. When they first began with CDPs, they would issue to the taxpayer certified mail and to the POA. Now the POAs receive their notifications via what? Regular mail. Okay, but to the taxpayer certified mail. All right? Now, I know you guys are tired of these DETLs, but this is important. All right? You need to know. However, DETL may also be remitted to the taxpayer by automated collection, ACS. ACS may issue a DETL. Notification by ACS is an automated process. You will receive a CP297A. You remember I mentioned a few moments ago, no, probably say I didn't pay attention to you, LJ. I mentioned CP297, LT11. Well, CP297 is merely a final notice of intent to levy for a business. CP297, automated, not by a revenue officer. Revenue officers don't issue CP297. ACS does. And that's for a business. However, a CP297A, I want you to watch your notices now. When they come in the mail, just don't throw them in the corner. That's a DETL. That's good for you to know. Because once you see certain letters behind certain notices, that's to perk your interest as to, oh, wow, we need to do something now. All right? Again, to the taxpayer's last known address. Why? That's legal. If it's not sent to the last known address, not considered valid. I want to throw that in there, all right? Sometimes your taxpayers have notified the government of the last known address. But like the non-filer, I'm sure they mentioned this last night, last known address, the taxpayer said, well, I never received the notice. You know what the RS says? Well, you never filed a darn return in the last 15 years. What do you mean? So we sent it to what? The address where you filed 15 years ago. You were notified. That is considered your last known address. That's where we sent your legal notice. Well, why don't you send it to where I live now? Well, file a return. Or prepare a Form 8822. But for businesses, 8822B for businesses. If you want to update your address, there needs to be clear and concise notification of the last known address. All right? Last thing on the DETLs, room for error. LT 1050AD appears extremely similar to the 1058. You may initially disregard the 30-day stay of notice period because you say, well, I have 30 days. Look out for that letter behind it. You don't have 30 days. It's already been levied. CP297, same thing. You may see CP297. You don't pay attention to the A. Taxpayer's already been levied. Just want to bring that up. Now, room for error before we move on. Premature issuance of DETL without verifying. Remember we just mentioned under the code, the IRS is required to do what? Verify the guidelines before they issue a DETL. Sometimes they don't, so make sure your job is to interact with that revenue officer. Did you do your job? Did you research this or did you just assume? That's where we as practitioners should interact with the revenue officer. Sometimes our job isn't easy. Sometimes we're dealing with a hostile revenue officer. They don't like us anyway, sometimes, most of them. Or sometimes they act very nice, like they almost just fell off a turnip truck or something. You know, I'm saying something's wrong here. You're too darn nice. You know, but those are the main ones that will chop your client's leg off, the nice ones. Be careful. They'll suck you right into that. I'm telling you, man. Okay, now legal application, improper application and interpretation 6331H with respect to determine the most recent 2-year period. Remember we spoke about that? There must have been in the prior 2-year period where your client actually requested a CDP, not an equivalent hearing. Even if they withdrew it, they requested a CDP, so that doesn't matter. So make sure the government reviews that properly. Here's one before we move on to the next issue. Law Officer Gary Rossi, he filed a CDP, however, on a non-CDP period. Sometimes when you file a CDP, you include a period that wasn't included in the CDP notice. That can happen sometimes. Well, they have a liability period, but they have not issued a final notice of intent to levy, but they have on these 5 periods, but not that 1 period. Okay, the IRS issued a DETL in error. I brought this case up so you can review it. So I want you to know, sometimes the IRS makes mistakes. It's your job to right that error. No, you cannot levy my client. You need to reimburse them for all the funds and any fees. There's a section on the RM where if they were harmed, if they paid any fees, the IRS is required by law to reimburse that. The firm was not entitled to damages. They weren't entitled to damages. However, the court determined that there was an issue of material fact concerning whether the IRS made a mistake. that which constituted negligence. They can be negligent at times. It is our job to verify, to clarify, to represent the taxpayer. We can't assume, oh, the IRS was right. Oh, you did file a CDP when in fact they didn't. Or maybe they did file a CDP but was outside of the 2-year window. Do not allow the IRS to run rampant on your case or your client. Sometimes they're right, sometimes they are not. You have a duty also to investigate the underlying elements of the case. You must know your case, and you must know your client. All right? And you must know the law also. That's the detail. That pertains only to employment taxes, so I thought it was relevant that you be aware of that. Now we're getting to the meat and potatoes. Now we're getting to the meat part. Trust fund recovery penalty. Everybody familiar with that? I should hear everybody say yes. At least heads nodding or something. Yes, employment tax matters. When your client doesn't pay the portion of taxes that are withheld, those are the trust funds. Only the portion that is withheld, not the matching portion. It can be very detrimental to a taxpayer. Now, as I said, this is a true case. I don't know, Vicky's not working with me on this case. I think Angelina's working with me on this case in the office, to whereas this young lady, I think her trust, just her trust fund portion, it's either 7 or 5 million. How did the government allow it to get that far? Yeah, I guess they were busy. We didn't have time. It should have sent CDPs or something. Maybe they did, but this is the same case, by the way, to whereas we were successful in having the corporation file the offering compromise on the corp. Great. Now dealing with the tax. This true case going on right now, giving some issues. Now the taxpayer requests not an offering compromise, but C&C. Part of our job is also to determine what the client qualifies for. You just can't say, oh, we'll file an offer. Nope. You always have to run the numbers. When you're doing anything besides running the numbers, you're making an assumption. Run the numbers. I don't know what you qualify for. Well, I want this. I know you may want that, but you may not qualify. Well, I saw it on TV. Pennies on the dollar. That is true. I've worked with some taxpayers where that did happen, but they qualified. I don't know if you qualify. I need your information. So I don't tell people, okay, we can file an offer. I don't know what we'll file on your behalf until I analyze your information. And I'm just saying that this is off the record. We're not. Some of us are doing too much free work. They come into your office, I want this, and you do all this work, and then you tell them what they say, what's your first name? Stephen. Okay, thank you, Stephen. Then they go down the street. Stephen did all this work. Yeah, and now they go down. We don't know there's a phase here. Number one, we need to determine what you qualify for. Okay, we analyze it. And during that phase, there's a small fee for that, not a lot. But we need to be paid for our time. So we analyze, we determine what they qualify for. Now that we've determined that, would you like for us to move forward with the case? Well, yes, I think I would. Now there's a separate engagement fee for that. But while you're determining, some of you give away all that good information and they take it down the street and let some bozo do it cheaper. And you haven't gotten paid for the time you put into it. I just threw that out there. Stop doing it. The reason I can say that, I did it. I admit it. Oh, boy, did I give away tons of work. But I don't do that anymore. Matter of fact, before I came to the CPA firm of Lawler & Wachowski, I righted my wrongs, Vicki. Both the Vickies. I righted my wrong. I found out I'm not doing that any longer. All right? You need to be paid for your services. These are the same people that will come back and try to sue you, okay, or file a complaint with OPR. And why are you going to file a complaint with OPR and you never paid me? The government doesn't care about whether you were paid or not. What do they care about? Did you sign the power of attorney? You getting paid, that's your problem. My issue is you signed the power of attorney. You're required to represent the taxpayer. Take care of your own internal affairs. Power of attorney, that's where we come in. You have a duty. You have a job. You're required to represent that taxpayer vigorously, and you didn't. So let's get to trust fund. This is an important impact of employment taxes. As I said from the beginning, you know how to file 941s and all that, but now you know about DTLs. Now we need to determine how do we handle trust fund. Code section 6672, trust fund recovery penalty, all right? Failure to collect and pay over taxes or attempt to evade or defeat tax. Believe it or not, that's a very serious accusation. Enacted by Congress to promote the payment of employment taxes, trust fund is considered a civil penalty, not criminal. We'll get to the criminal portion. But it's a civil penalty. Formerly referred to, it wasn't back in the day of Vicki, is it McGinn? Yes, sir. Back in the day of Vicki McGinn and LG, it wasn't called the trust fund recovery penalty and no such thing. It was called 100% penalty. That was in the courts, read all the court cases, 100% penalty. Now they've gotten, what, legal proper, okay? So it's called the trust fund recovery penalty now, but it was formerly referred to as a 100% penalty. Same as, who taught non-filers? Did you teach non, okay. Did you mention to them what they were called back in the day, Cheryl? But she knows what they were called. They weren't called, they didn't call none, they were called, they weren't called SFRs, substitute for return. Say it again. Dummy returns. Read all the court cases.
I do mention dummy returns.
You do mention that, but right. But I'd say,
CTRS still has a reference.
absolutely. Dummy returns, yeah. But now they're called SFRs. Very nice and proper. But back in the day, that's right. Dummy returns. Some of you never heard that, but that's what they were called even in courts. But here we're dealing with the trust fund recovery penalty. These are the taxes that were collected, withheld on the employee's taxes, just that portion, all right, and not paid to the government. That's why they are to be held in trust. That's what they call trust fund. Remitted to the government on the schedule that we showed you previously. That's the importance of that little schedule. You know, you need to submit them 5 days afterwards or 3 days afterwards. And if you don't, you're subject to penalties. These are trust funds. They can become criminal, but right now, the 6672 is a civil penalty. All right? Trust fund. 6672 is the primary provision. However, when you get into the sevens, 667, 66s is the penalty alley, 72 is criminal. When you get to the 70s, read the language in Code Section 6672 and 7202. When you leave here, read the language. Almost similar word for word. Almost. Except you're subject to criminal willful failure to collect or pay over taxes, the criminal version of the 6672. They can assess the tax on the 7202, so you need to be very careful. If you're dealing with, remember I mentioned earlier, that's why I mentioned the ATRO, Abusive Tax Transaction Avoidance Revenue Officer. They'll be, not only will they deal with 6672s, now they're looking to now make the assessment on the 7202 for these taxes that are withheld. Oh, by the way, I'm sorry, I forgot to mention to you. I mentioned the taxpayer to hold the $5 to $7 million that we're dealing with right now. We requested not offering compromise. Why? Because she didn't qualify for an offer. We felt as though she wouldn't be proper. Our goal as an enrolled agent is to file the proper relief, the proper request. So we requested C and C. That's what she qualified for. She's not able to make payments. How can you make an offer in compromise if you can't pay anything? That's not an offer. You have to give something. She couldn't. So C and C. Revenue officer sent that to the revenue officer in March, if I'm not mistaken. Send all the information. Fully compliant, send all the information. Revenue officer doesn't bounce back to us until 5 months later. That's October. That's this month. Revenue officer states that he's not accepting C&C. Matter of fact, we have recommended that the taxpayer file, prepare, and submit a postnuptial agreement, which are very effective in certain states. Matter of fact, they are effective in New York. It depends on when you file it. In Texas, they're very valid. But he stated, not only are we not accepting your C&C, but I'm not recognizing your postnuptial, which they have to follow under community property. And Texas is a community property state. They have to look to federal law first. They have to look to Code Section what? You're absolutely right, Maryland. Code Section 66. Thank you, Maryland, for that. Code Section 66, community property. Under certain things, community property law, they have to look to what? State law first. California, state law first. You have to look to state law to determine how community property is to be operated at the federal level. So we did that. We followed state law first, they filed a properly posted nuptial. Now he's saying, I'm not accepting that. I'm not accepting your illegal postnuptial. By the way, I intend to make a referral to the Department of Justice to seize all of your assets. This is all in one letter, by the way. When did I say we submitted all the information to him? Did I say March of 2025? And he's just responding to me in October, nothing in between, no phone calls, no letter, nothing, but I get this letter. Department of Justice, I'm not recognizing your postnuptial. All of this. And it's all relative to, and by the way, he also mentioned the IRS should never have accepted your corporate offer and compromise, so I believe he's being retaliatory. In my opinion, I don't know that yet until I get some more information. I will be digging in on this case, but I think he has an issue because they accepted the corporate offer. Now the taxpayer can't pay the trust fund portion, and he's saying, I don't believe. Oh, by the way, one more thing he threw in there, Cheryl. Alter ego. Alter ego. I believe you're an alter ego of the corporate. Wait a minute. This corporation that earned millions of dollars, hired X number of employees, and you're thinking this person is an alter ego? That's almost like a sham corporation or something. Oh, really? Do all this and mention all of that and then file alter ego liens? It's a horrific case. But that's what we do. We just don't deal with the little simple matters as an enrolled agent. Do you understand how important? Nobody does what we do. I don't care who you are. We're the only ones licensed to represent taxpayers before the IRS. Not CPAs, not attorneys. They're licensed in civil. Attorneys are licensed in civil or criminal law, state, and CPAs are licensed by the state. Enrolled agents, you're licensed directly by the federal government to represent clients. Nobody has a license to represent clients before the IRS but you. Keep that in mind. And we deal with some very critical, serious matters. Here, I spent 3.5 hours on the phone before I came to New York with Angeline discussing this case. I almost went and got a rope to hang myself first because 3.5 hours, I'm saying, but we were going back and forth with the elements, and nominee liens and things like that, alter ego and so on, researching case law. But it can become very serious, making a referral. My goal now is the IRS, is he following proper procedure? That's the first thing I'm investigating on the trust fund case. All right, let's get into this. All right, now, I like this one. They're having all these meetings. I suppose I'll be the one to mention the elephant in the room. They're talking about everything else, but the elephant in the room is the trust fund. It's going to get you. I suppose I'll be the one to mention the elephant in the room, but let's see things straight. Dumbo, you paid the suppliers, the vendors, and employees, but not the IRS? You paid everybody else, but not the IRS? That's the crux of trust fund. You paid everyone else, but you didn't pay the IRS. And you used the government's funds. You technically stole the money. Technically, I won't say that to the client, but you used the funds. Those were trust funds. And you used it to pay vendors and everyone else. Okay? Now, here's a sample of the calculation. Federal income tax withheld, trust fund portion, that's for federal income tax. All of that is trust fund. There's no matching on that. Employer portion, 0. Now, Social Security, $9,300. Trust fund portion, half that, matching. That's the employer's portion. Medicare, that amount, half that. Trust fund, employer has to match that. Total amount due to the government. The trust fund portion, as you can see, almost always equals somewhere between 70 and 75% of the tax due. That's a big portion of that tax due. It runs somewhere between 65 and 75%, depending on the amount of payroll paid. Here's the employer's portion there, but the trust fund portion is the 15. The employer's portion is the matching, but the trust fund is the 15,000. So you make this analysis as to what portion of this is trust fund, 75% generally. Taxpayer allowed to designate of involuntary payments. Now, you're allowed to, when you enter into an installment agreement, I know we're not speaking about installment agreements, but your client make payments, they're not allowed to designate payments pursuant to an installment agreement, okay? But if your client is not in an installment agreement, it would be in your advantage to recommend that if the client intends to make payments, they're considered voluntary payments, you're allowed to designate that payment, and instead of having it paid towards this portion, always have it applied towards the trust fund portion. Reduce that liability. You have the authority to do that. When the RO involves sending a payment with letters to request a trust fund, calculate the payment by adding employee withholding, all of these. If submitted with instructions, ROs must follow the instructions. They must correct any misposted items. I had a case, my client designated all the payments on this corporation in Fort Worth, Texas. Each and every one of them. I think he made about between 25 and 30 payments. We designated each payment towards the trust fund, which minimized the impact on the individual and reduced the corporate taxes. Now, when it came time for us to represent the taxpayer, okay, there should not have been any trust fund remaining. Why? Because we designated the payment. Did the government designate those payments that we instructed? None of them. None of them. So we end up having the taxpayer file a tax court petition, and because we did designate the payments, the court says, wait a minute, IRS, you can't do that. They designated the payment. No, no, no. You apply all this towards the trust fund portion. Taxpayer end up owing nothing. But you're allowed to designate the payment if it's a voluntary payment, not pursuant to an installment agreement. So if you have an employment tax case and your client wants to make payments on a pending employment tax liability, designate the payment towards the trust fund on an employment tax case. Now you minimize the impact on the individual. Stop allowing the government, because if you don't, the government will apply it to where they want to apply it. First to what? First to tax, then the penalty, then to interest, and then trust fund is later, maybe 2 cents left for that, okay? Trust fund portion only includes the employee portion withheld. We mentioned that includes withholding, FICA, Social Security, and Medicare. It is required to be collected truthfully, accounted for, and paid over to the government via those Form 941s.
Can I just ask you a question about the trust fund? So
Yes, ma'am.
I've had clients that have been put into an installment payment.
Yes.
Of course, when you start working with the RO, you send them the check, the first payment to get in, and you mark it as trust fund. But then subsequently, they want you to be on automatic payments. And those payments can't get marked because they come out automatically. They can't get marked specifically for trust fund. So
That's
do you
correct.
recommend, instead of doing that, mailing in a payment, can you mail a payment directly and not to the RO? Can you mail it directly to
You
the
can. And what's your first name?
Michelle.
Michelle. Just want to make sure she knew her first name. She knows her first name. She was saying where you're working with a revenue officer and they want you placed on what they call direct debit. Okay? And her question was, if you're placed on direct debit, wait a minute, you're not allowed to designate that payment. So they kind of remove that element from it. Great recognition. I'm glad you brought that up. Because if you agree to that direct debit, there's no allowance for designating the payments. She said, well, can I just submit the payment separately? You can. Don't agree to the direct debit. Now, however, some elements say, well, we won't do this unless you enter into direct debit. Well, now, if they have any additional funds, just send them in as a voluntary payment. That's if you're compelled to enter into a direct debit. But you're absolutely right. You enter into that direct debit agreement, there's no way to do what? Designate. So I'm glad you became cognizant of that. You must be able to designate, and you can't if you enter into direct debit. Unfortunately, that's one of the issues they have. Now, 941 tax deemed assessed dates, that's important when you're dealing with trust fund. We have this up here again. How do you determine trust fund? The deemed assessed dates. Now, timely file, if it's timely file, April, July, October, January, the IRS treats each period as assessed. For example, the 941s that you prepare for 2025, okay, you file them in April and all of this. But when does the deemed assessment, when does the statute begin to run on those? Okay, not until April the 15th, 2026, the ACED, okay? Even though you filed it in 2025. ACED doesn't begin to run on any of those periods, those 941 periods, until 2026. It's good. You need to know how to calculate that because the IRS has 3 years to assess even trust fund. They have 3 years. And the case that we have, a big case in Texas, the RO sent the letter April the 14th, one day before the statute expired. Okay? However, we're going to get into this, though. See, taking a step back, and they sent this, and she sent the letter 1153. I'm a little bewildered. Shannon, she sent a letter 1153. Yes, she sent it right before the ACET. But by the way, how can you make a recommendation to assess the trust fund when there's been no trust fund interview? What's that, the Form 4180, if I'm not mistaken? Yeah, Shannon, you know that's the Form 4180. The Form 4180 Trust Fund Recovery Interview Form where the RO brings you into the office, interviews your client. Did you do this? Did you do that? Did you do this? Okay, now that I've seen all this, now I recommend that you be assessed a trust fund. Now I will issue the 1153. How in the world do you have any basis for issuing that letter 1153 recommending the trust fund when you haven't even interviewed my client? You don't know if they were responsible or not. This is what this revenue officer did. All we received was the, letter 1153. I challenged that by saying, how can you issue this when you didn't interview my client? You just made an assumption. No, what she did was she ran up against the statute. Okay? And she had to do something. So she issued the letter 1153. Good for me because I challenged it. I said, and then later, now they want to interview my client. So am I a bad enrolled agent because I said nope? Am I a bad enrolled agent? No. Why do you want to talk to my client now? You issued the letter 1153, all right? And we all know when that letter is issued, what happens to the statute? Stops running. It's tolled on the day of issuance. It tolls the statute of limitation. We all need to be aware of that, all right? But anyway, that due date, Howard Street's each period is April 15th the following year. This is known as the deemed assessment date. Example, a third quarter 941 filed October 31st, 2024 is deemed or considered April 15th, 2024, ACET. Well, that should have been 25. The ACET would begin to run to the next year, all right? Read RM 5, 19, 14, 2, 2. That's where it gives you the guidelines regarding this. Now, responsible person must be assessed against a responsible person. That's my whole point. How do you know my client was responsible if you never interviewed them? How do you know that? Number two, can an entity be considered a responsible person? Yes. I thought that was the strangest thing, but they assessed an accounting firm as a responsible person once. The responsible person must have a duty to collect, account for, and pay over the tax. If that person didn't have the duty to do all of these, they should not be considered a responsible person. I've had trust fund cases, however, to where I threw my client under the bus. Not literally, but with the trust fund, they must be deemed responsible and willful under employment tax cases. Not either or. Everybody with me? Not one or the other. Both together. They're linked. So I would go in, Vicky, and say, yes, my client was a responsible person. He or she was the president of the corporation. They ran all the operations. They did all of that. You got us. However, they were not willful in the non-payment of the tax. And that's a defense. That's something you have to carry the burden of proof on, Code Section 7491. I said, yes, they were responsible. Yes, Marilyn.
Yeah, the responsible person is an entity, and the entity goes bankrupt. Does the non-trust portion be included in the bankruptcy?
Well, technically, she said, if an entity becomes a trust fund and they file bankruptcy, does the non-trust fund portion be included in the bankruptcy? Actually, in bankruptcy, you can include all of the taxes, trust fund and non-trust fund. However, the trust fund portion is not dischargeable. But you can include it in the bankruptcy. But it's not dischargeable at all. But the non-trust fund portion is dischargeable. That's the difference. Yes, ma'am.
What if you hire a payroll company and they steal your tax deposits?
Okay. If you hire a payroll company and they steal your tax deposits, you're still responsible. You can't delegate that technically, unless you can prove there's some other elements you can prove, but technically, you hired them. You get my point? That's the government's argument. You hired them, okay? You should have been reviewing all the reports periodically. You should have been obtaining transcripts of someone in your company, making sure the deposits were being made. You didn't do that. You were negligent. So no, we won't let you off. But there again, you can file bankruptcy, but they will not be discharged in bankruptcy. They can be included. Trust fund portion or employer taxes are not dischargeable in bankruptcy, but they can be included in the payout, not dischargeable, however, not at all. Trust fund nor actual taxes. There can be multiple persons. Now, back in the day, there again, Vicki, back in our day, they called it the shotgun approach. You know, shotgun has all these pellets, right? It's shotgun. I'm going to shoot everybody I can see. I'm going to get as many people as I can. Well, I was just a janitor. I'm throwing you in there too, okay? But that was the shotgun approach. Anybody they could. There can't be multiple persons. A responsible person is not required to be an officer, director, or a member, a board member. It could have been the secretary. It could have been the bookkeeper. What matters is, where is it? Here. This is what carries the trust fund. You had a duty to collect, account for, and pay over. It doesn't matter what your title was. You could have been the flower keeper, the cook. Did you have a duty to do that? And that's where a lot of these bookkeepers and secretaries get hung up. They give them the duty to do all of that, and all of a sudden, when the government finds it, they're in shock because they're now being assessed with the trust fund, and they were the lowest person on the totem pole that was being paid. The president was getting hundreds of thousands, and they were only getting hundreds of dollars, but yet they're the ones assessed with the trust fund. So how could this be? I was just doing my job. But you had a duty to account for, collect, and pay the tax. That's the danger of trust fund. All right? Burden of proof is attached to the government to establish willfulness. Responsibility, that's the element of the 4180. Were you responsible? Willfulness. Now, normally on the trust fund recovery penalty regarding employment taxes, any of you ever prepared a Form 4180, assisted a client with that? Just raise your hand. She has. Come on, more, come on. Just two? No. All you enrolled agents in here, you've dealt with the 4180, haven't you? Oh my gosh, we're going to take you to 4180 school. All right? 4180 is the interview form that they are required. They should have that form. They prepare that form, ask your client all these questions. Now, page 1 just deals with mainly responsibility. Did you have the due? Did you deposit taxes? Did you have the authority to do this? Did you have the authority? And blah, blah, blah. Yes, yes, yes. Yes, I had the authority. I signed bank accounts. I did all of this. That's page 1. Page 2, willfulness. Did you guys have any meetings about this? What decisions did you make? We don't prepare page 2. I'll give you page 1. Wait a minute, LG, that's a Form 4180. How are you going to tell your client? I can tell my client very easily. Per the RM, if this person seems to be responsible, they only required usually to accept page 1. But I'm not having my client give you information, throw themselves under the bus to show, oh, not only was I responsible, but I was willful. We're not doing that. Now, you want to have an issue with me and my client? You can do that. You can't compel. Matter of fact, if you read the RM to this day, it informs the revenue officer to not provide you with the Form 4180. Don't give it to the taxpayer, and then it states, and by the way, don't give it to the representative, the power of attorney. Don't give them a copy, which we know we can get a copy of it anyway, right? But they're not required, they're not allowed to give you with a copy. Why? They want to bring you in. Or it is allowed, by the way, to be conducted over the telephone. That's per the RM. So if anything, if I allow you to conduct the 4180 with my client, it will be via telephone. Why do I not want my client sitting there in front of the revenue officer? They're very intimidating. The client starts sweating. No telling what they'll say. Never take your client to a trust fund recovery interview. Yes, ma'am.
Yeah, so before, I think I understood you said that if you're working this case and you have a POA, you've got responsibility. Okay. Supposing you're doing an after-the-facts payroll, like a CFS. Client says, this is what I paid out, so you submit the 941, and it turns out the client didn't send the money in. Is there any responsibility on the payroll person such as me, to be responsible then for what they said they sent in and didn't.
No, there's no way you can be responsible, even if it's after the fact, because you didn't have the duty to collect, pay over, and report the tax. You were just preparing the report. So you're not responsible. Definitely
But I
not.
submitted the report.
That's okay. You don't have to. But you weren't responsible for. Don't forget those three elements. Okay. Must have a duty to. Were you responsible for collecting the tax? No, you weren't. No. Account for. Maybe you accounted for it on the form, but you were responsible for paying over. You have to have all three of those connected together to be assessed to trust fund. So just because I'm a payroll processor and after the fact they came with the payroll, I prepared it, I submit. And by the way, stop signing returns, any type of return, anything on behalf of a client. I don't care if you are a POA. I know we have a lot of authority. Have your client sign all forms, period. For example, on the, what form is that the government says they would prosecute whoever? Oh, even this form. You signed a form 4180? Okay. You signed it, LG? Then we can prosecute you. But wait a minute, this is my client's information. We don't care. IDC, I don't care. You signed it. We will prosecute whoever signed the form. So let's stop signing forms on behalf of our client. Yes?
Even the payroll forms of the 940,
Oh, in the payroll forms, absolutely.
don't sign them.
I recommend. Now, some of you have done that. Back in the day, I did it, but once I found it, no. Because even that, let's say she's not, but just by the mere fact that you signed it, you will be called in just to determine, possibly, it's Michelle, isn't it? Yes. I was just testing you. You passed, okay. All right. Even Michelle could possibly be deemed a responsible person. Why? Because she signed the form. But I'm sure she can defer that. She can mitigate that by showing, no, I just prepared the return and I just had the responsibility just to submit these, and I did. I signed them, but I wasn't required to account for it. I definitely wasn't required to pay over. So, yes, but I did. So every person, remember the shotgun approach? We're looking for anyone that had any attachment. So by the mere fact that you signed in that form, I'm calling you in.
Does the fact that we electronically file the forms through our program, our software, does that constitute our signature?
That could, yeah, because you're signing off as the, yeah, even if you sign it, file electronically. We're just trying to bring up these employment tax matters. How can I be part of this scenario if all I did was prepare or submit? We will get anybody. Our arms are far-reaching. You may have had a play into this. You may have been responsible. Just that mere element of signing or sending something on behalf of that taxpayer. We're not trying to scare you. We're just trying to say, hey, let's gear up for it. If I do it, okay. Now, how can I protect myself? Am I really a responsible person? I know I'm not, so I'll continue doing it, but I'll know that I have to defend myself. Where were we? We were right here. All right? Willfulness. Now they must determine, well, you're willful. I can't be willful if I didn't have the duty. I could not have been willful. So you're safe there. All right? Fraudulent intent is not required to establish the standard of willfulness. It has nothing to do with fraud. Were you willful? Did you preference other creditors over the government's trust payment to the government? Did you pay, first of all, did you pay your rent? Yeah. Pay your utilities? Yeah. You pay other payroll? Yeah. Did you buy office supplies? Yeah. But you didn't pay the government.
I mean, did you pay yourself?
Did you pay yourself? Absolutely. All of these questions are based upon page 2 of the Form 4180. If you didn't, so I didn't see enough hands go up on the 4180, probably 2 hands, my friend in the back and her. I want all of you to get printed. Go when you leave here or when you go to your room, access a Form 4180, get ready. Because if you're an enrolled agent, if you're representing clients, and we're having a lot of payroll issues, what's this thing they came out with, the ERC? You remember that? Employee retention credit. Some people are still waiting on their money. Some people are receiving, however, what is it called? A CP 105 or CP 106C, CP 105C. You all familiar with that? I take that as a no. So, disregarding employment retention credit, to whereas they disallow all of it or disallow a portion of your ERC. They're receiving the letter CP 105 or the CP 106C. Okay? That's where they either disallow partial or full disallowance. Okay? So you will be, they will receive, but that's all related to payroll, these payroll, because the 941s were wrong, or you didn't have enough employees, or you're under the 5,000. Who knows what the reason is? It's all explained in the CP 105. but your client has rights there as well. We'll discuss that. Now, the person and entity have knowingly and intentionally disregarded their duty to be subject to willfulness. You must have knowingly, and intentionally disregarded the rules regarding payment of the tax. So even if you were, that's why I told you I throw my clients under the bus regarding responsibility. Oh, yeah, they were responsible, but they didn't pay if they weren't willful. That's something. I have to raise a defense on that. The government, there's a burden of proof attached to the government to establish willfulness. That burden shifts to the government. You say my client was willful, you prove it. And one of the first steps they do to prove it, they have you prepare page 2. I think it's section 3, page 2. So if you're not familiar with a Form 4180, boy, are you fortunate. Are you blessed? But get ready. Don't get caught off guard. Even if you haven't done one in years or never done one, when you leave the New York State Society, I'm accessing that form. I want to know what this form looks like. I want to know the questions that they ask. And by the way, on this particular one, she asked to have, she sent the form letter, which we're about to speak about the letter. How am I doing on time?
You still have like 13 minutes.
13? All right. What you think, Cheryl? All right. But here's the interview. Here it is here. IRS Revenue Officer General required to conduct the interview. She didn't. She just sent the letter 1153. Why? She was up against the ACED. She knew she had 3 years from the deemed assessment date. She had to do something. So she sent the letter 1153. I said, wait a minute. You didn't even talk to my client, right? Okay. The interview process is documented via Form 4180. The taxpayer is entitled to representation during the interview process, all right? I do not allow them to speak to my client, but only in limited circumstances. Don't forget, read the RM. They're not allowed to send you the form. They either want you to bring the client in for an in-person interview or they conduct it over the phone, all right? But now that form is readily available, all right? Now, by the way, whenever you have a trust fund case, you want to request a Form 4183. That's an internal document that outlines the trust fund, how they calculate it. Make sure you always request a 4183, all right? Advise the taxpayer how to prevent liabilities, obtain documentation in support of your TFRP assertion, attempt the interview 4180 and then suspend the interview if the taxpayer wants representation. This is the IRS trust fund initial contact. Let's say the IRS contacts your client, and your client does not have representation, or they do have representation, and our revenue officer begins in on your client, so wait, stop. I believe I need representation. They're required to stop the interview immediately, okay? So inform your clients of that. They're required to stop the interview. Here's the RM portion, RM 572423. They can't go on with the interview. They have to have representation. Now, penalty assessment. Here's the Form 1153, since I only have 10 minutes now. It's required to be remitted to the taxpayer, inform them of the proposed intent to assess prior to the actual assessment. The government is not allowed to just assess the trust fund portion regarding employment taxes. They're required, first of all, to do what? Interview your client. After the interview, then inform them we propose the assessment of the trust fund. They just can't assess. They're not allowed to do that. All right? Some of them, as we just stated in the case I'm handling now, they didn't even interview the client. So get ready. All right? Now, your taxpayer is allowed 60 days, not 30 as a normal appeal, not 90, same as a notice of deficiency, 60 days to file an appeal. They're allowed 60 days from the date of the letter. The statute of limitation is told, however, for 90 days upon issuance of the letter. But you have 60 days to file an appeal. All right? Letter 903, if you ever receive one of those. They just updated this, by the way, May of 2025, per the RM. Now, why would you update something in the IRM if you didn't intend to use it? You get my point? Some of these things are so subtle you never know unless you review the IRM. Entitled, you haven't deposited federal taxes, is entitled by the IRS Revenue Office to alert taxpayers to the provisions. What did I say about the 7s? 6 is just a penalty. But the 7s, criminal, all right? Provides the federal district court with jurisdiction to pursue civil injunctions, but also, in the 7202, criminal, all right? They just updated that in May 2025. I want you to be aware of that, which means some of your clients may be receiving a letter 903, more serious than a regular trust fund assessment. Now, you ever heard of diversion of taxable income? I want to bring this up. I only have a few minutes. The Office of Chief Counsel issued a memorandum dated August 12, 2024, which concluded that trust fund assessments should be considered as a diversion of taxable income and therefore should be reported as taxable income via the Taxpayers Form 1040. Now, this is under review. In other words, you assess me the trust fund penalty, so I owe that if you assess it. Also, by the way, now the IRS is attempting to have your client include this assessment also on their 1040 returns as taxable income. You mean you penalize me, I have to pay it over here? Now I have to include it in my taxable. It's called a diversion. Now, they haven't approved it yet, Cindy, but I want you to get ready for it, okay? We're just warning you. Now, here it is. Here's the post right here, CCSB HQ. TM, that's the person that proposed it. The CCM note above has also mentioned that the diversion of income taxability is in addition to the trust fund assessment. In addition to us assessing you millions of dollars of trust fund, that's a penalty, we want you to include it in your income tax. Now, they haven't approved it yet, but we're telling you now, because it may come down the pike if they approve this, how many people then will be required to file bankruptcy knowing that trust fund taxes are not dischargeable, but they're going to be compelled to file bankruptcy anyway. But they can be considered via an offering compromise. Okay? All right. Assessment statute, the trust fund must be assessed within 3 years of April 15th, subsequent to the year of all those quarterly returns. Don't forget, 3 years. If they miss that 3-year period, they're not allowed to assess the trust fund. That's why that agent sent that notice 1153, 1 day before the statute expired. Okay? If the quarterly returns in question was filed late, the statute is then 3 years after the date the return was filed late. All right? Trust fund defense. Didn't have knowledge, that's a defense. I wasn't willful. If I didn't know that they were due, that's a defense on willfulness. Lack of authority, I didn't have the authority. I didn't have the duty to pay over. All right? Lack of funds. Now, that's for a Ninth Circuit case, Shannon. That doesn't work in the Fifth Circuit. Well, the taxpayer went to court and judge, we didn't have any money in our bank account. Yeah, we are liable. Yeah, we paid all the other vendors, but just we couldn't have paid the trust fund because we didn't have any money left. I thought that was the strangest thing, but that was a Ninth Circuit case. That was out of California. Texas, they say IDC. I don't care. So you know how I know? I tried to use that case in the Fifth Circuit. I think they're still laughing about it right now. You know, person is not responsible. Person did not, they weren't willful. I can show you by the actions. Person did not actually sign checks. Okay? These are all defenses. Person only signed certain checks. I didn't sign payroll checks. I only signed certain other checks, but not consistently. These are all potential defense tactics. Okay, here's the trust fund cases I want you to review when you have time. I hope I'm pronouncing this right. For Bazi, okay? Quatron Accountants, that's the accounting firm that was assessed the trust fund. You don't think a firm can be assessed? Read that case. All right? P.J. Winter, Michael Williams, Crowd Management Services, Ellen Marino, James White. These are all resources you can review within the element of employment tax matters. Okay? Key takeaways: encourage clients to maintain. We always do that, but do they do it? That's how they end up with the trust fund. Be aware of the DETL. But now you know about discuss trust fund implications. You could be liable. You could be. It didn't matter what your title was. You could be liable. Consider the Form 4180 positions. Okay? Want you, everyone, if you haven't gotten one, that's okay. Okay, but I want you to read it. You may be drawn into a trust fund case if you never had one. I kind of almost grew up on those. That's why I'm so familiar with them. Matter of fact, the revenue officer would require that your LG, now I'm requesting that your client appear for this trust fund recovery interview. You can appear with your client if you like, but I must interview the client personally. That's per the RM. However, per code section 7521C, if I'm not mistaken, the IRS cannot do what? She raised her hand. Go ahead and tell me what that that Internal Revenue Code states. Did I see you raise your hand? Oh, I'm sorry. IRC 7521C states that the IRS cannot compel the presence of your client in any conference, hearing, or meeting in lieu of a summons. In other words, they want your clients there, they must issue a what? Summons, and before you issue a summons, you must have what? PC, probable cause, grounds. Just can't issue one just because I can. So, therefore, the IRM says I must interview your client personally, but the code, the law says you can't compel the presence of his client. So we must adhere by the law. Write that down if you never read it. I want you to read it for yourself. IRC 7521, small c in parentheses. These are elements that we use in our representation. We just don't say do this because I say do it. Oh, you're wrong. No, we use the elements of the law, court cases, the code, treasury regulations. That's what we raise to defend our clients. Let's keep going. Consider appeal rights upon the receipt of the letter 1153. What's that letter 53? We propose the assessment. How many days do you have to appeal? 60 days. I use every bit of it. Sometimes I file the appeal on the 59th day. Look at it this way. Suppose you file the appeal on the first day of the 6-day period. Did you get any brownie points? No. You have 60 days. I use it to research, build my defenses, and then I submit my appeal. And that's what I did on this case. Not the one for $7 million. This one was only $3 million. But she issued the trust fund without conducting the interview, and so I filed the appeal. Then she wants to interview my client. I said, no, ma'am. You should have done that before. By the way, why did you even issue the letter if you didn't know my client was responsible or willful? No, that's an element I'll take up with appeals. And that's what I'm dealing with now, appeals. I normally have about a minute, but I hope this class regarding employment taxes, I brought up 2 elements I know that were very important to you, in my opinion, DETL and trust fund, because that's what you deal with on these employment tax cases. Not just the preparation, but the underlying element, the legal element of how to defend a client, being aware of the trust fund, being aware of a DETL. How can they levy my client on these employment taxes? And everybody that didn't have a 4180, review it, access it, is there. I know my time is up, but I want to thank you all very much for inviting me. Thank you so much.